Welcome along to the FinWell Daily Brief. This is our 61st episode coming to you on June 16th, 2025. A lot's happening today.
Indeed. Quite a bit to unpack from the markets. But maybe before we jump into the day's action, let's ground ourselves with a key financial fact, something quite foundational for many in India.
Okay, sounds good. Laying the groundwork. What have you got for us today?
Well, it's about those government-backed investment schemes. You know, things like the National Pension Scheme or NPS, the Public Provident Fund PPF, and the Senior Citizens Savings Scheme, SCSS.
Ah, yes, the classic pillars.
Exactly. And they really are pillars. Even now in 2025, they are critically important for millions of households. It's that combination, you see. They offer safety, which is huge, known tax benefits, and pretty steady, reliable returns.
It's that bedrock, isn't it? Something solid against all the market noise.
Precisely. For you thinking about your own finances, they represent that stable foundation, a real counterpoint to, say, equity market volatility. Essential stuff.
It's definitely essential context. Okay, so with that foundation in mind, let's shift to the more dynamic side. How did the markets actually close today? This is based on the closing data at 3:30 p.m. IST.
Well, it was certainly a positive day overall. The bulls were definitely out. Looking at the Nifty 50, the large cap benchmark, it closed at 24,946.50.
Okay, and that's up how much?
That's a solid gain, up 227.90 points, which is 0.92%, so a good jump.
Right, nearly 1%. And was that positivity seen across the board? What about mid and small caps?
Yes, it's spread out. The Nifty midcap 150, it finished up 0.75%, closing at 21,594.45. And small caps joined in too. The Nifty Small Cap 250 gained 0.5%, 0.50%, ending at 17,296.30.
Broader market strength then.
Absolutely. If you look at the Nifty Total Market Index, that covers everything. It was at 0.80% at 13,002.70. So yeah, markets definitely ended up today.
Good to see that broad participation. Okay, let's pivot slightly. What about the bond market? Any movement in the India 10-year government bond yield?
Interestingly, it was remarkably steady, finished pretty much flat, right around 6.36%.
6.36% and holding steady. What does that tell us, especially with equities rallying?
Well, it suggests a certain calmness about future interest rates, maybe. Traders are obviously looking at global risks, but the RBI's neutral stance seems to be, providing an anchor.
So it keeps borrowing costs stable.
Largely, yes. That stability impacts corporate borrowing, potentially affects things like loan rates down the line. So it's relevant for you because it signals a kind of underlying stability in the financial plumbing despite the stock market action.
Got it. Stability in bonds. But you mentioned a different story for the currency.
Yes, exactly. The Indian rupee, it actually lost some ground against the US dollar today. It depreciated, finishing at 86.04 per dollar.
86.04. Okay, what was pushing the rupee down?
Two main things being cited. First, the U.S. dollar is just strong globally. That's a continuing theme. And second, those persistent foreign portfolio outflows, money leaving the market.
Right. FPI outflows putting pressure.
Yeah, when foreign investors sell Indian assets and convert rupees back to dollars, it increases demand for dollars and weakens the rupee.
And 86.04? Is that a notable level?
It is, actually. It's the lowest the rupee has been against the dollar in about 2 weeks.
Okay. So for you listening, why does this matter?
Well, it affects quite a lot, right? The cost of imports, if you're sending money overseas, and it directly impacts the returns for those foreign investors we just talked about. It's a key external factor.
A clear reminder of those global connections. Okay, let's zoom back into the equity market rally itself. Sensex up over 650 points, Nifty near 24,950. What was the kind of story behind that strong move today?
The narrative seems to be that investors consciously decided to look past the recent Middle East tensions.
So risk appetite returning.
Exactly. Instead of focusing on geopolitics, they were taking cues from positive signals in other Asian markets and rotating back into equities. It felt like a deliberate shift back towards, risk assets.
Okay, and where did that money flow? Which sectors were leading the charge?
Well, it was very broad-based, which is positive. Every single sector index ended in the green.
Every single one.
Wow.
Yeah. But the clear leaders, the ones really attracting attention, were IT and FMCG, fast-moving consumer goods.
That's interesting. IT and FMCG are often seen as more defensive plays, aren't they?
They are, yeah. Which maybe suggests investors are looking for a mix, like growth potential, but with some relative safety, perhaps. The Nifty IT index itself only gained 0.02%. Closing at 38,469.25. So another huge percentage gain, but it was definitely drawing interest. And FMCG, companies whose products people buy regardless of the economy, they were strong too.
So even the perceived safer sectors played a big role. What about the other end? Any notable laggards, even if everything was up?
Well, maybe the best laggard, if you can call it that, was the Nifty PSU Bank Index. It still finished up a respectable 1.1%, but it gained the least percentage-wise among the sectors.
Okay, so still positive, just less so than others. Speaks to the breadth of the rally.
Now, you mentioned earlier that midcaps did particularly well, getting 0.75% with the Nifty Midcap 150. What drove that specific outperformance?
That seems to have been fueled by just broad buying interest picking up in that space. We saw some specific stocks really stand out.
Any names?
Yeah, companies like Bharat Electronics, Honeywell Automation, they were among the top gainers in the midcap index today.
And wasn't there some company-specific news helping them out too?
Yes, good point. Both Bharat Electronics and Honeywell Automation actually announced final dividends today.
Okay, so that likely boosted sentiment for those specific stocks.
Very likely, yes. It shows how company news can sometimes amplify these broader market trends. Mid-caps often attract buyers on days like this because of that potential for faster growth, but you always have to remember it comes with higher risk than large caps.
Good point. Higher potential reward, higher potential risk. Now, just circling back quickly to the currency.
Right, the rupee.
Yeah.
While equities were strong, that move to 86.04 per dollar is definitely something to keep an eye on.
Lowest in 2 weeks, you said.
Yes. And it just hammers home the point that even on a strong day for domestic markets, those global factors, the strong dollar, the FPI outflows, they're still exerting pressure. Our market doesn't operate in isolation.
Absolutely clear. Okay, let's shift gears now from the broad market to something very specific, an investment opportunity, or perhaps a warning sign, depending on how you look at it. Let's talk about the Patil Automation Limited IPO.
Right. This is currently open. It's a main board IPO. But important note for you if you're thinking about it, the closing date is coming up fast, June 18th, 2025.
Okay, deadline soon. What are the other key details? Price band, size?
The price band is set between 315 and 330 rupees per share, and the company is aiming to raise about 525 crore rupees in total. Those are the basics you need.
Basics covered. But as we always say, knowing the basics isn't enough, especially with IPOs. You have to look for the potential red flags. What should investors be aware of here?
This is absolutely crucial. And for Patil Automation, there are several significant points to consider. First off, very high client concentration. Over 70% of their revenue comes from just 3 auto OEMs. 3.
Wow, only 3 clients making up that much business. That sounds risky.
It is. Think about it. If just one of those clients has problems, maybe production issues, or decides to switch suppliers, or if their specific market segment slows down, bang, it hits Patil Automation's revenue hard and fast.
And that risk is amplified because of the industry they're in, right?
Exactly. They are heavily dependent on the automotive sector. And the auto sector is famously cyclical. It goes through big swings in demand based on the economy, consumer confidence, interest rates, all sorts of things.
So Patil's business is inherently volatile because its main customer base is volatile.
Precisely. They might do well when the auto sector is booming, but they could face real headwinds during downturns.
Okay, client concentration, sector cyclicality. Any other flags? What about their financials?
Yes, looking at their books, there are signs of potential working capital pressure. They have high receivables days and high inventory days.
Can you break that down? What does that mean practically?
Sure. High receivables means it takes them a long time to actually get paid by their customers after they've made a sale. High inventory means they're holding onto stock, either finished goods or materials, for quite a while.
And that ties up cash.
It absolutely ties up cash. It can strain their cash flow, make it harder to manage day-to-day operations, especially, again, if the auto sector slows down and collecting payments becomes even tougher.
Right. And one more point that experienced investors often look at in IPOs.
The anchor investors, or rather the lack of them in this case. There aren't any major, big-name institutional anchor investors participating significantly here.
Why is that potentially a red flag?
Well, it's not always a deal breaker, but big institutions have teams doing deep research. If they're not participating in a big way, it might suggest they have some reservations and perhaps they just see better opportunities elsewhere. It's another piece of information for you, the retail investor, to consider.
Okay, so let's pull all that together. High client concentration, cyclical sector dependence, working capital pressures, lack of major anchor investors. What's the critical takeaway for someone thinking about this IPO?
Look, the company has shown revenue growth in the past, that's true. But given these significant risks, especially the dependency issues and potential cash flow constraints, this IPO really has to be viewed as a high-risk proposition, particularly for individual retail investors.
So caution is strongly advised.
Absolutely. This is not a situation where you just apply and forget about it. You need to really dig into the fundamentals, understand these risks we've talked about, and be prepared for potential volatility if you do decide to invest. Do your homework thoroughly on this one.
Very clear advice. And speaking of protecting your money and avoiding risks, let's talk about something incredibly important for everyone involved in the market. A serious warning. Beware of bucket shops.
Yes, this is critical investor protection knowledge. It's basically about fake brokerages, outright fraud.
How do they work? Tell us the story.
Okay, imagine you want to buy some shares. You contact what looks like a brokerage firm, maybe online, looks legitimate. You place your order, you send them your money.
Right.
But they never actually execute your trade on a real stock exchange like the NSE or BSE. They just record it internally.
So the trade doesn't actually happen?
No. They bucket the order. Essentially, they are betting against you. If you buy a stock through them and the price goes up, they have to pay you from their own pocket because they never bought the actual shares.
Ah, okay. But what if the price goes down?
That's where they profit. If the price falls after you buy, they just keep your money because no real loss occurred on an exchange. They might even manipulate the prices they show you internally. Their goal is for you to lose.
And the risk to the investor? It sounds enormous.
It's potentially total loss. Victims can and often do lose their entire investment. Because these aren't real trades on regulated platforms, there's no SEBI oversight, no investor protection fund, nothing. They often have slick websites or apps that look real, but it's all a facade to steal your money.
That is truly frightening. So what is the single most crucial piece of advice for you, our listener, to avoid falling victim to this?
It's simple, but absolutely essential. Always verify your broker's SEBI registration. Always.
SEBI, the Securities and Exchange Board of India.
That's the one. Before you give anyone your money or try to trade, go to the SEBI website, check their registration number. Is this entity actually registered and regulated? Only deal with SEBI-registered brokers and trade only on regulated platforms. It's your fundamental shield against these scams. Verify, verify, verify.
Not emphasize that enough. Verify your broker's SEBI registration.
Yeah.
Only trade on regulated platforms.
It's the golden rule.
Okay, let's tie everything together now. Looking back at today's market action and all the points we've covered, what's the overall analysis and outlook?
So the big picture today was that market rally, driven by investors looking past geopolitics, taking cues from Asia, and rotating back into risk assets. Key things we saw: broad gains, IT and FMCG leading, midcaps outperforming, partly helped by specific news like dividends.
Right. And we also had that stable bond yield around 6.36%, suggesting some calm on the domestic policy front.
But, and it's a big but, we also saw the rupee weaken again to 86.04. That's the counterpoint, signaling those ongoing external pressures, the strong dollar, FPI outflows are still very much in play.
So, given that mixed domestic strength but external headwinds, what's the actionable advice for you as an investor looking ahead now?
Well, connecting those dots, the environment suggests prioritizing quality seems prudent. Focus on good quality large cap stocks, maybe maintain some allocation to defensive sectors like the IT and FMCG we saw leading today, just to balance things out against potential bumps.
And given the risks we highlighted?
Definitely exercise extreme caution with leveraged positions in midcaps, and frankly, avoid high-risk IPOs like the Patil Automation one we discussed. Protecting your capital is key right now.
So the theme is quality, some defense, and be very selective about risk. What specific things should listeners keep their eyes on in the near term?
Okay, 3 key things for you to watch. 1, global cues. Any major international news, economic or political, could shift sentiment quickly. 2, keep tracking those FPI flows. Are foreign investors buying or selling? It matters. And 3, watch the currency. Rupee volatility against the dollar remains a key indicator of that external pressure.
Global cues, FPI flows, currency watch. Got it. Excellent summary. Now, before we wrap up today's Finwell Daily Brief, just a quick but important message for all of you listening.
Yeah, we really hope today's discussion gave you some valuable perspective on what's moving the markets and, crucially, some of the risks you need to be aware of. Our aim here is always to break down this complex information into something clear and usable for you.
And the best way, truly the best way, to make sure you don't miss our daily updates, the market analysis, the IPO spotlights, those vital investor warnings like the bucket shop discussion, is simply to subscribe to the podcast.
Please just take a second now, whatever platform you're listening on, find that subscribe or follow button for the Finwell Daily Brief. Hit it. That way the latest episode lands right with you every day. Helps you stay informed.
We'd also genuinely love to connect further. You can find SOS Finwell on LinkedIn. Search for us there, connect. It's a great place for more insights, discussions, and just staying plugged into the financial community.
Absolutely. We look forward to seeing you there.
Okay, so just to quickly recap the main points from today's podcast. A strong rally in Indian markets, IT, and FMCG sectors showed notable strength, but the rupee did hit a 2-week low. We took a hard look at the Patil Automation IPO, highlighting some serious red flags for you to consider, and we delivered that critical warning about duck shops and how to protect yourself.
And as we close out, we wanted to leave you with a thought about the right mindset for investing over the long haul. This comes from the value investor Robert Olstein.
He said, "The desire to perform all the time is usually a barrier to performing over time."
It really makes you think, doesn't it? It's such a powerful reminder that investing isn't about winning every single day. Trying to chase every rally, reacting to every dip, aiming for constant perfection, that often leads to bad decisions, taking on too much risk.
And it gets exhausting.
Exactly. It can actually prevent you from achieving good, steady returns over the long term. Patience, sticking to your plan, focusing on fundamentals, that usually beats trying to be a hero every single day. Something for you to reflect on in your own approach.
A really valuable perspective. And finally, just our standard but very necessary disclaimer.
Yes. Please remember, this report and discussion are for informational purposes only. All the market data and analysis are based on information from SEBI-registered exchanges and public filings as of market close today, June 16th, 2025.
It is absolutely essential that you consult with a certified independent financial advisor before making any investment decisions based on what you've heard here. This is not personalized advice for your specific situation or goals.